All right, well, we'll jump right into this. I do want to give a quick update on where we are in terms of what's happening in across our primary row crops. There's obviously been a lot of change, a lot of things that have been moving over the last bit, and it's shown in some of the volatility that we've ended up seeing. One of the things I do want to point out, the graphic on the right-hand side of the screen, it's the vegetative drought index. And you'll notice that it's changing over time. And the reason why I wanted to highlight this is we've had a really strong weather market this summer. And you can see as we move through time, it will show that the yellow and the dark reds will indicate, where there's prevalence of vegetative drought across the region, how that changes over time. This will take us right up until last week when the drought monitor came out. But it's a really useful tool, and it does highlight some of the challenges that we've seen across crop markets and why we've seen some pretty wild swings that I'll talk a little bit about. There's a tremendous chance that we're going to see some yield variability across some regions. I guess the good news that we're seeing is if we speak in general across Tennessee, and obviously there's going to be exceptions to the rules, and driving across a big chunk of the state over the last couple of weeks, most of the crops look like they're in really good condition. It's one of those ones where obviously it's not in the bin yet, and so we still have to factor that into our risk management plan. But we have seen in general a pretty strong growing season for Tennessee. When we look at it more from a national standpoint, what we do end up seeing is we see more of a regional diversion. So in general, you look at the Eastern Corn Belt has been for most of the growing season in better shape than most of the Western Corn Belt, with some of the exceptions being up in the northern areas there. So it is one of those ones where when the USDA came out with their yield estimates at the start of the year, and this didn't really have anything to do with the current production estimates, is just a trend adjusted yield based on what their forecasting weather system was. They forecast a yield of 181.5 bushels per acre. And as we got into June and early July, and we seen some of the drought stress that was out there, a lot of those estimates plummeted. And one of the challenges that ended up coming up is they started releasing just in the beginning of August here some of the anticipated yield estimates, and national average yield is going to play a real important role this year as to which direction prices end up going because of some of the variability that we've seen as a result of stress across different areas. And so the latest number that I've seen, based in part on satellite imagery and some field level verification, is a corn yield of 177 bushels per acre. That's a national average. And then for soybeans, 51 bushels per acre. So as we think through that, there are some ramifications based on what happened with the acreage report back in June and where we are projecting yields. That is something that gives us kind of an indication of which direction prices are trending. The weather market will be coming to a bit of a close here as we get into August. We're not going to see as strong of an influence. Yes, there still will be an influence, particularly when we look at things like cotton, and it always is dependent on how active of a hurricane season that we see during that harvest interval in terms of how the crop will end up finishing out. And so one of the other big ones, I know I've kind of beat this drum for the last year or so, but when we look at kind of our price risk management strategy, one of the things that we've always said, and I still think it's a tremendous asset to end up having a lot of on-farm storage, but the interest to carry grain in storage, the interest expense, is something that producers really need to end up taking a look at. And I'll give some examples of why that's an important consideration. So when we look at kind of I wanted to break this down in different commodities because there's very different weather implications based on the commodity that we're looking at. And so this is a report that USDA puts out each week, and it gives an indication of the growing regions, which are the green map on the left hand side, and then the drought is the red stripe component. So you can see where there are primary areas of corn that's in drought, but it can be a little bit misleading. And so when you look at the bar graph on the other side of the slide, what this one really ends up showing is the severity of that drought. And so when we look at it across the US, yes, we have a pretty large drought area when you look at the map, but when you look at the severity, Less than 8% is an extreme or exceptional drought. And again, so it's one of those ones where we have to be cognizant of, yes, where's the drought happening, but what is the severity of it and what's the yield ramifications? And some of the preliminary yield estimates that we've had out there still indicate a pretty strong national average yield, and we've seen prices soften as a result of that. When we look at soybeans, very similar. Obviously, the growing areas are pretty similar, but you can see some minor differences in terms of where some of the drought overlaps with more dominant soybean growing areas. When we look at cotton's one of those ones where if you compared it to last year, I think it was over 50% of the area was in drought. This year, it's only about 20%. And obviously, Texas can change with some of the conditions that are out there. But overall, when we look at drought in terms of cotton, it's not as big of an influence as it has been in the most recent past years. Just to switch it up just real quick for supply and demand, I'm not going to go through this entire table, but I did want to end up highlighting a few things because I think there's some real key numbers to keep an eye on when we're looking at USDA projections. They'll release a new WASDE report on Friday, and they'll also have some new acreage data that will be put out there. But the numbers that I'm really paying attention to is one, that national average yield. I think that there's a potential there. If we're above that 177 range, we're going to have an over 2 billion bushel carryover and potentially well over 2 billion bushel carryover. And that's going to give an indication that prices are probably going to continue to slide a little bit lower, all else being considered. The second number that I'm really focusing in on is that export number. What is going to be our export share? There's a whole bunch of factors that's going to go into that. Global demand is going to be one of them. One that we've been tracking, I don't know how many people follow Southern Ag Today, but there was an article published this week that talked about exchange rate differences and how that's got a potential to play some roles, particularly in soybeans, but also in corn in terms of export and destination, where China and other large purchasers of agricultural products are going to be sourcing some of their supplies. Now, obviously, there's other considerations that are embedded in there, but it is an interesting component to end up following. And then the last two numbers on here is obviously the stocks numbers. Both the U.S. number, I think, is going to be incredibly important. Stocks to use is one that's usually pretty good in terms of predicting price. So the more that we end up seeing that stocks number climb, and if we keep use consistent, what we see is downward price pressure. But when we look at where that U.S. average price is, they're projecting a year-over-year drop of $1.80 per bushel. So again, when we end up looking at that, that does provide, again, some more support that we're going to see softer corn prices as we move into this harvest interval. When we look at soybeans, the key number that I'm looking at there is the 18 or the export number of 1.85 billion bushels. The yield number is important, but that acreage number that was kind of a shock back in June, and I'll talk about a little bit about what that did in the market, really provided some support to soybeans over the last couple of months. We've started seeing soybeans slide pretty quickly these last couple of weeks, and there's a couple of reasons for that we'll talk about a little bit later. But for me, one of the big numbers is what's going to be on that foreign stocks, and particularly what's going to happen down in Brazil is going to be so important for the soybean markets. When we look at cotton is one of those ones where I think we're going to see a much lower abandonment percentage than what we ended up seeing last year. Obviously, where that ends up coming in is going to be largely contingent on how the season finishes down in Texas, but that's going to translate into that production number. We've seen a rally in cotton markets where we actually broke out of the current trading range. And a lot of that's been kind of supply concern driven, but in order to end up maintaining a price rally, we're going to have to see some stronger demand numbers. And what we'll want to end up seeing is what's going on with export numbers. When we look at wheat, wheat's one of those ones where if you look at the trends, the one that I'm real interested in is looking at those stock numbers and then those export numbers. And this is one where I think you have to look at it over time. You can see the trend in wheat exports from the U.S. has trended down and pretty substantially down over time. But so is our stocks. The one that is always in the background in terms of wheat is what's going on over in Russia and Ukraine. But again, what we've ended up seeing is reasonably tight stocks for the U.S. And a little bit of a tightening in terms of foreign stock. So there's some support there, but again, you're going to have some linkages between corn and wheat. One of the things that I always like to throw in here, because we do use this as usually a base of our risk management plan, is I just did some quick updates in terms of crop insurance projection at 75% level. And so will there be crop insurance payment? It seems very unlikely for most of our producers in Tennessee. I think a lot of our yields, if you look at the yield trigger, I think most of our producers are going to be well above those yields at the current market price. Now, if we see continued weakness, I think it would have to be pretty dramatic for us to be able to end up triggering yields or indemnity payments in a lot of cases. So again, I don't foresee crop insurance unless we see tremendous drops in prices, or we see some type of weather-related event that would end up destroying crops coming in as a viable source of revenue as we move through this year. When we look at projected profit and losses, we've obviously seen some softening in input prices, fertilizer being one of them. You know, a lot of it is going to depend on the timing of those applications. But what I wanted to highlight on this projected profit and losses is even with some reasonable yields based on where we are, and some estimated variable expenses, I think there is still the ability to end up having some profitable outcomes. And so again, this is one where I think producers really need to sit down and see where they are in terms of what they have invested in this year's crop, what are their yield expectations, and what's their reasonable expectation in terms of price. Because when there's some profit on the table, it's one of those ones where I think you need to end up looking, how can I end up protecting against falling below that profit level? And what are some of the strategies I can use to end up making sure that I'm enhancing that profit? When we look at actual prices, this is the December corn contract. And as I mentioned, the volatility was pretty extreme this year in season. A lot of that is due to some of the drought that precipitated across a lot of the Corn Belt. And then some of the forecasting as well. I mean, one of the ones that I'll say, and this isn't a slight, I mean, it's a very difficult job to forecast the weather, but there was a lot of forecasts that never came to fruition this year, and that translated into volatility when we looked at who caught a rain and who ended up not catching one. The other one that was a big hit to the corn market was the June acreage report. It was one of those ones where there was a lot more acreage on the corn side of things. I've kind of highlighted it with that blue arrow that's on the screen. But what we've seen is a pretty strong downtrend as we've went through this year. So again, as we move some of that weather uncertainty, or continue to remove the remaining weather uncertainty is a better way to end up phrasing it, we're likely going to continue to slide a little bit lower as we go into harvest. When we look at soybeans or wheat, is this one, what we ended up seeing was that tremendous decrease. And then you see that it follows, if you go back and forth between those two slides, the peaks in terms of wheat kind of correspond with each other. So those two are moving together, which is expected. If you do look at the differences between the two charts, so you will pick up some of the differences primarily when you see shock events, like when they ended up having some of those missiles that ended up hitting the ports in Ukraine. And so there's still some volatility there that can create fluctuation. But for the most part, with that area of the globe, most of that risk has been factored into the markets and accounted for. And so unless there's something dramatic that comes out of that region, I don't foresee that being a dominant force in markets on a long-term basis. When we look at soybeans, again, this is another one where there's the drought influence, but then you had that acreage report at the end of June that really was supportive to soybeans. Now, there's a couple of, it can be a double-edged sword when we see these types of rallies in soybeans, because we're not the only ones that see this. And so when we look at what has precipitated this decline, obviously we've seen some yield estimates indicating that the U.S. crop is probably going to be a little bit stronger than where it was. But these higher prices going from June all the way into July has also ended up increasing the likelihood of an increased South American crop. And if we think back to what occurred last year, Brazil had a record crop. Argentina had a drought-stricken crop. Well, if we get another close to or record Brazilian crop in Argentina gets back to normal in terms of their soybean production, it's really going to hurt our export numbers, and that number will decline because we won't be as competitive on the global market. I think our domestic markets will remain very strong, and we will have lower supplies, but will we be able to be competitive on the global market for exports is one of the biggest challenges I think we see in soybeans. And so again, the recent trend has been for prices to continue lower. A lot will be contingent upon what happens in the production season down south. When we look at cotton futures, this is one that I wanted to highlight. Cotton was in a very well-established range. It was trading pretty consistently between 77 and 86 cents. We broke out. The question on everybody's mind, is this an anomaly, or are we going to end up seeing a real charge over 90 cents? I think it's going to be real hard for cotton to break above 90 and stay above 90 without some indications of some stronger export demand. There just hasn't been the demand out there on the global stage for cotton. Now, I think by the time we get into later in the winter, I think we might end up seeing some of that demand resume, but it'll probably be closer to that November, December, or maybe into early 2024, before we really start to see that demand hopefully catch up. Now, there was a whole bunch of caveats that you have to put on that in terms of what's going on in the general global economy. So when we look at market factors, there's a couple of things I'm watching. There's always, a whole bunch of different factors that are affecting prices simultaneously, but I kind of just picked out one key factor for each one of the commodities. The first one is corn. I've talked about, I think if we have a greater than 175 bushel per acre average yield, which it looks likely that we will, I think that's going to result in prices being closer to $4 than $5. Soybeans, like I said, the domestic market and the domestic situation is supportive for higher prices, but I think South American production, both the record crop that Brazil is currently exporting and the likelihood that we'll see greater plantings due to these high prices that we've seen in June and July, I think that provides some downward pressure in soybeans as well. Cotton, again, I think the supply disruptions only takes us so far. You have to have demand to maintain that rally and get above that 90-cent level that a lot of producers are looking for. On the wheat side of things, the changes in global stocks and our support of production, I think, is going to end up rebounding. And then we do have still some issues in Ukraine and Russia. And so when we look at current futures pricing opportunities, and I didn't show basis on here, but we do have some reasonable new crop basis offerings that are still available. It's going to vary depending on where you are in terms of the region. But I do think that looking at how can I end up protecting against further declines in the futures market, I do like looking out a little bit beyond the harvest interval. If you have the ability to store, that's why I've got the March corn and soybean futures contracts at 5.13. If you lock in on using a short hedge, I think it gives you a pretty reasonable base point to start with, and then hopefully you can end up taking advantage of our seasonal basis improvements as you move through the year. Similar story with soybeans. I think if you're looking on the cotton side of things, I think at anything above 86 cents, I would consider end up doing some sales. The caveat that I will put on this with entering into futures market protections, particularly through a short hedge, is the liquidity and interest requirements. I will talk a little bit about interest on the storage side, but it applies to any funds that you end up having that is required to maintain a position in a futures market as well. So closing with the storage component, again, this is our historical or 10-year average change in price from the harvest low in September through the remainder of the months of the year. The one key difference on this is just ran some basic analysis on interest cost per bushel to carry it per month, and it's 3 to 4.5 cents depending on what your interest rate is, because we're at a bank prime rate of 8.5% right now. So that's just the interest cost. So again, if you have producers that have operating facilities, or even if they don't, the foregone interest on that revenue needs to be considered as you look at storing. So if you're talking 3 to 4.5 cents per bushel per month, plus any other additional storage costs, I think that has to be factored into what your expectations are. Is there still the ability to use storage as a very powerful tool? Absolutely. I think it's still one of the better marketing tools, but it is a tremendous increased cost as to where we have been in the past that I think needs to be accounted for. Similar thing with soybeans, when you look at 8 to 10.5 cents per bushel per month for interest plus any other storage costs. So again, I just think it needs to be something that producers are aware of, that holding that grain in storage is an interest cost, whether they're maintaining a higher operating loan balance or whether they're foregoing another opportunity if they're operating on a cash basis. I think it's real important to end up factoring in those increased interest costs on the grain held in storage. So with that, kind of my take home message is there is still a bias, particularly in corn and soybeans, for further price weakness as we enter the harvest period. It's going to be real important where some of these national acreage estimates and projected yields come in. Friday is going to be an interesting day because we get confirmation of the FSA acreage data. That's the producer reported data. So we'll take a look at that. There will be a ton of yield projections that come in and field tours that are going to show a whole bunch of variation, I suspect. So where that number comes in, we'll have to end up seeing. I think it's real important to really look and see where we are from a profitability standpoint, know what your cost of production is, know where you're breaking even. It's not that you want to price at a break even. Obviously, we're in it to make some money, but we want to know what those per bushel costs are and where we come out ahead, and how much we can end up doing, and comparing that to where we are in terms of the market to identify opportunities both during the harvest interval and then as a storage component as well. And then lastly, I think just looking at where we are in terms of a storage capacity relative to production, and then considering what those true costs are as we move through the remainder of harvest and into the remainder of the marketing year.